Hello everyone. In this video, I will be discussing the bank's balance sheet trends and the performance over time in the Australian market. Well, there has been a couple of obvious changes in terms of banks' assets and liabilities over time. The first one is there has been an increase in cash and deposits with the Reserve Bank of Australia. That's essentially in response to the liquidity difficulties during to the global financial crisis. The most obvious change we can observe in the bank's balance sheet over time is there has been a marked shift in banks lending from business loan to residential mortgage loan, which grew from 19.1% of total asset in 1990 to 37% by 2013. So it's almost double residential mortgage loan. Since 2000, there has also been increase in the scale and reach of international operations. The shift from commercial lending to mortgage lending or household loan has been due to the part to change in the structure of the banking industry. As I indicated previously, that in the early 90s, a number of building societies gained banking authorities and their large portfolios of retail housing mortgage loans in relatively localized areas were reflected in the growth in bank assets. So those have been merged with the banks. However, regulations have also influenced a shift in lending. For example, the capital adequacy regulation of banks introduced in 1989 required banks to hold, on average, less capital per dollar lent for residential mortgages relative to commercial lending, making residential mortgage lending more attractive in terms of risk-adjusted return on capital than business loans. In this graph, we can see the funding composition of the banks in Australia. I think the most obvious changes in the trend we can see is the proportion of domestic deposits, while it was about 40% until 2008 or until the global financial crisis. However, after the global financial crisis, you can see that banks' reliance on domestic deposits have increased. It's inconsistent with the bank's strategy to be self-reliant. And also, you can see the short-term debt has declined substantially from about say 35% to 20% from the 2007 to 2016. Other funding sources have not substantially changed over time. With liabilities, capital provides bank funding, and since 2008, the Australian banks have also strengthened capital in response to the GFC and regulatory changes. Australian banks have a strong underlying capital positions going into GFC, and some suggest that this was principally due to the conservative regulatory approach taken by APRA relative to regulators to other countries. Since 2008, Australian banks have increased both the level and quality of their capital, strengthened significantly in more recent years by robust profitability. You can see in 2013, while this was the level 2013, 14, and 15, while this was their level of capital according to Basel II, they have been increased significantly over time, and so is the Basel III required by APRA. So there has been a marked increase in the capital in 2016, and that is continuing in 2019. So you see that APRA's minimum capital requirement, and also we see that more stringent transition program for Australian banks relative to the BIS recommendation. BIS is the Basel Committee for Banking Supervision recommendation. Now, the bank's profitability as well as net interest margin. You can see in the left slide we show bank profitability. I mean the left graph we show bank profitability, and the right the figure we show the major banks' net interest margin. While in the early 1990s were marked by substantial bank losses, gradual recovery occurred throughout the decade, and until the severe dislocation of the GFC in 2008, banks operated within a very stable and the profitable market. So you can see there has been a decline in the bank profitability in the 1990s. However, there has after that they are pretty much stable. The performance of the major banks has been particularly strong and long-lived. So major banks are shown by this purple line, and the blue line is representing the regional banks. The major banks' 30-year average ROE is 16%, and their ROE has been positive in all year since the 1980s, except 1992. You can see that except the 1992, they have been positive all the time. And the major banks' ROE has been higher than the regional banks. You can see that most of the time these are higher, and this gap has been widened since 2007. So from 2007, you can see that these major banks' ROE is much higher compared to that of the regional banks. There are a number of reasons for this widening gap, but the first one is the GFC affected the competition in the industry, particularly through the cost of funds. Before the GFC, the cost of funds for the smaller banks was only about 10 to 15 basis points. Greater than that was of the major banks. However, after the GFC, this rose to more than 80 basis points. In the right, as we see net interest margin. Net interest margin is the difference between interest income and interest expense divided by earning assets of the banks. The margins of the major banks were affected during the 1990s by the growth of non-bank mortgage origination, leading to reduced spread. Means the difference between lending and deposit rate, reduces spread on housing loans. While the drying up of most residential mortgage securitization program during the GFC, bank had less competition in the housing loan market and reclaimed some lost ground from the 1990s. So you can see that there has been a steady decline in the net interest margin until the global financial crisis, and after which there was a slight recovery, and that again declined until 2016. This graph shows a comparative picture of the Australian banks' profitability with the other banks. So the comparable performance of Australia's major banks relative to large banks in other developed economies shows that while Australian banks had only modest dips in the ROE during the GFC, which is indicated by this, the UK, European, Japanese, and US banks incurred large losses. You can see all of them incurred large losses during the GFC. By 2014, the US, UK, and European banks' ROE had not recovered in the pre-GFC level. So you can see they have not recovered yet the losses that was incurred during the GFC. So that's the end of our discussion on the banking trends over time in the Australian market. In the next video, we will be talking about the regulatory structure of the depository institutions in Australia. Thank you.